Hit the record button. It is 1 o'clock. We'll go ahead and get started. My name is Tyrone Fish.
Tyrone froze, and I'm still seeing him frozen. So I'll go ahead and step in. I'm Scott Hallbaker. I'm serving as the executive director of NACAA, and today we have with us Hunter Biram, uh, the Southern Extension Risk Management Education Group out of Arkansas. Approached us shortly before the Montana Billings meeting, and we were thrilled that they were able to come on and support one of our Search for Excellence in Production award programs. And part of that, we also gave them the opportunity to come in and speak to us today. So, Hunter, see you're with the University of Arkansas, so maybe you can tell us a little bit about yourself. And he's going to talk about the current state of the U.S. crop insurance industry. Hunter, welcome.
Well, thanks so much, Scott and Tyrone. Yeah, so as Scott was saying, I'm an assistant professor at the University of Arkansas in the Ag Econ department, primary extension appointment, but I have some teaching responsibilities as well. I'm also one of the associate center directors for the Southern Risk Management Education Center, who Ron Rainey is the director of. Erica Fields is my co-associate director. And today I am very excited and humbled to present on the state of the federal crop insurance industry in the United States. I hope that y'all got your coffee because maybe some of y'all don't think this is as exciting as I do, and that's okay. I totally get it. I mean, there's a lot to this, a lot of alphabet soup because we're talking about the government here, right? But without further ado, Scott, if it's all right with you, I'll go ahead and start off the presentation.
Sounds great.
Great. Let me share my screen, make sure I'm sharing the right one. All right, are y'all seeing my screen?
Yep.
Great. So make sure this. Okay, great. Yeah, so what I want to talk about today is yes, I'm going to talk about the state of the federal crop insurance industry and how it's a public-private partnership with the private industry as well as with USDA. Talk a little bit about the background, talk about the different products that are offered, and join us with Farm Bill programs. We know that with the One Big Beautiful Bill Act, there are actually quite a few changes in there that benefit farmers overall. And so in this, I'm also going to be promoting a workbook that I've written with a team of extension specialists at the University of Arkansas and at Mississippi State University. We co-authored this workbook called The Fundamentals of Federal Crop Insurance. It's not just Arkansas or Southern specific. It can be applied anywhere in the U.S. And so we hope that you all find this to be a resource that's helpful for you as you're helping farmers to make those crop insurance decisions in your respective counties across the U.S. Because, yeah, it's a very hard decision. I mean, there's a lot of alphabet soup, a lot of different terms, different concepts, and really insurance can just be a booger. I mean, listen, I have to buy, health insurance and car insurance, property and casualty, and all those things, and just the word insurance can kind of get me stressed out. So hopefully today, though, I can bring the temperature down a little bit on insurance and provide some resources that can help you in all your county level programming. So to start off with, we're going to talk about the structure of the U.S. crop insurance industry. So here's the cover of the book, The Fundamentals of Federal Crop Insurance. We're going to be in chapter 2 from this workbook. It's about 100 pages long. There are 11 chapters. We're not going to cover all 11 today. We don't have time for that. I'll provide a primer on a few of them, though. Here's a QR code that should take you to a PDF that's posted on the U of A's website if you want to be perusing through that. In the workbook, we do have the chapters, but there's also check your knowledge or little self quizzes at the end of each chapter. And good news, we do provide the answers in the back of the book so that you can check your work. So the U.S. crop insurance structure. So what is the structure of the industry? So if we just start at the top left with agricultural producers, so we got farmers, right? Farmers are going to buy insurance from a local insurance company who obviously are going to sell to farmers. The local insurance company, they contract with what's called an approved insurance provider or an AIP. In some instances, they're one and the same, sometimes they're not. But the local company is going to contract with an AIP. Currently, there are only 12 AIPs across the U.S., and we're going to talk about those in just a moment. Now, continuing to work our way back towards USDA, so that's the private part of this structure. Now, the public part of the structure is USDA and the Federal Crop Insurance Corporation. So the FCIC, Federal Crop Insurance Corporation, provides the administrative and operating expenses, provides premium subsidy, and provides reinsurance to the AIPs. The USDA administers the Federal Crop Insurance Corporation, and they also rate crop insurance products. So what I mean by rate is they price it. So USDA is responsible for the pricing of these products that ultimately will be sold by AIPs through local insurance companies to farmers. So in one picture, there's the private part of this industry, and there's also the public part of that, and that public-private partnership. So again, you go from USDA to the Federal Crop Insurance Corporation to the AIPs to local insurance companies, ultimately to farmers. Like I said, there are a total of 12 AIPs who provide reinsurance to these local companies who sell the crop insurance. If you'd like a list of those, check out the AIP listing on the RMA's website. So AIPs have the choice to take on or to accept policies or to retain is one word that's used, or to pass on these policies or to cede or say, you know what, I don't want to take that policy on, it's too risky. So AIPs have the choice to take those on or to pass those on to other AIPs who think that maybe they want to handle that risk or not. AIPs also provide reinsurance to these local agencies who will engage in direct sales with producers. Notably here, producers will likely not directly engage with the AIPs. There's only 12 of them, and there are how many counties? Probably close to 3,000 counties. You guys probably know the exact number. But think about that. I mean, you got 3,000-ish counties, and there's going to be several farms within each of those counties, but there's only 12 AIPs. So it's unlikely that a farmer is going to directly engage with said AIPs. Okay, so this is a list of the row crop, cash crop insurance providers. So think about corn, soybeans, wheat, rice, cotton, peanuts, and so on. You've got your Farm Bureau, AgriSampo, that's a popular one in Arkansas. I've seen some that do country. I've seen NAU country, Pro Ag. I've seen, although I've heard that they may be leaving Arkansas. And I've heard of Great American. Great American writes insurance in many places that I've seen. And so this is just a broad list of who these insurance providers are, these approved insurance providers who go under contract essentially with USDA to sell these policies. Okay, so we're going to go from the row crop to the now livestock price insurance providers or LPIPs. And so you're going to see that there's two differences. Farmers Mutual and Precision do not write the livestock price insurance. They just write the cash crop insurance or the yield and price insurance for row crops. And then here's an agent locator. So if you wanted to, you could go to USDA RMA's website and go to their agent locator. And I brought up an example of Batesville, Arkansas, which is around close to my hometown of Floral, Arkansas. Batesville is actually our county seat. And you can see who these local insurance providers are. So, I mean, right off the top of the list, you see the Gibson Insurance Group, and they do not pay me anything. It just popped up on the search engine, and so you can see that Gibson, it did not pop up on our AIP list. Well, that's because they're a local company and they're going to be contracting with another one of those larger AIPs. Okay, so I'm not sure how we're doing questions. If you want to drop a note in there at any point, ask a question. If you want to unmute your mic, if you have access to your mic, just drop in at any point and ask me a question. Otherwise, I'm going to just keep going forward. But you can please interrupt me, stop me at any point in time. I'll be happy to take any questions or comments. So now we're going to go into the purchase process and important dates. So there's the industry structure, the AIPs, local companies, who are the AIPs, and so on. Now we're going to talk about how do you, or what does the purchase process look like and important dates in that process. So starting in the top left-hand box, you see producer makes a choice before the sales closing date. So the producer is going to the farmer is going to make a choice on which crop they're going to insure, which product they're going to choose, what coverage level they're going to choose, and what units they're going to choose. Now, all those could be foreign concepts, and that's okay. We're going to talk about those in just a moment, but those are some choices that a farmer's going to have to make. So already, if you're familiar at all with like the ARC and PLC program, which is your Title I, your commodity program through FSA, that's a more simplified version of risk management. Well, this is a less simplified version of risk management because there are so many choices. That date in particular, we're going to look at those dates here in a minute. That date varies by state and crop. I think in some instances it does vary by the county. So we're going to take a look at that in just a minute. But there is a date where you have to make a choice. If you don't make a choice by that date, you either don't get the insurance if you're a new insurer, or you get the same insurance that you had going into the season. So if you want to make a change, but you missed the sales closing date, you can't make a change. You just have to take on the coverage that you had in the previous year. There's an option for prevented planting, which I know that in Arkansas and across the Mid-South along the Mississippi River, we had a lot of rain at the beginning of April. We had about 3 months worth of rain, about 3 days. And so we had a lot of prevented planting this year. And so prevent plant is another coverage that I'm not going to go into great detail of, but there's a date here that is very important. So if there is a prevent plant option that's chosen, there's a final planting date that you had to make that decision by. So pretty much if you didn't get the crop planted by the final planting date, you can then choose that prevent plant option. Okay, even if you did prevent plant, there's a choice to ensure possibly a second crop. So there may be another step in this process that you have to make another decision. Throughout the growing season, losses will be reported. So let's say we're past final planting, we're past the second crop, we're past prevent plant, and now we're actually growing our corn, but we're facing losses like maybe there was a derecho, maybe there was hail, maybe there was a flood event after the corn had already emerged. And so losses will be reported throughout the growing season as we get to harvest. Once we get to harvest, a final yield at the farm level will be reported. And so that's going to be using a FSA 578 settlement sheets from your elevator to tie that production to the acreage to determine what that final yield is going to be to determine your final payments at the farm level. After harvest, prices have been determined. There'll be some indemnities that are calculated if you had the revenue option. So we're going to talk about a yield option, revenue option for insurance. But this is, in short, what the process looks like throughout a typical insurance year. For corn, sales closing dates, we see that across the Southeast, largely February the 28th, but in most other parts of the country, March the 15th. Texas is kind of unique. They have three different sales closing dates. They have March the 15th in the Northern Panhandle. In the eastern part of the state, they have February the 15th for corn, and down the southern tip, January the 31st. So that's sales closing. You got to make that decision. And then final planting date, so that'll be used for determination of prevent plant. That varies widely within states even here. Largely it's by state, but even within states we see some differences. So looking at final planting dates, we could even choose Missouri is a really good example because it looks like they have four different sales closing dates. They've got May 31st, they've got May 25th, they got May 15th, and they've got May the 10th. So they have four different final planting dates. Sorry, if I said sales closing, it's final planting dates in Missouri. Arkansas's got two for corn. And again, I stress this is just for corn. They're going to change by crop. And that's for agronomic reasons because we don't plant all of our crops at the same time. It's better to plant some crops earlier, some later, and so on. And so that's why there are a lot of differences here amongst all these counties. For soybeans, sales closing dates, they're only going to be three. Again, January 31st for southern part of Texas. Most other places is going to be either February the 28th or March the 15th. For final planting, there's not as much variation in that final planting date as there was with corn, but still quite a bit of variation relative to the variation in sales closing dates. So we see Arkansas, like Mississippi, Tennessee, Kentucky, Louisiana, all have that June 15th final planting date, as well as in Iowa, the northern part of Illinois, the far northern part of Kansas, the northeast part of Colorado, and most of Michigan has that June 15th sales closing date. But we do see that there's some others. So up in Minnesota, and then it looks like Wisconsin, I had to think about my geography for a second. They've got the June 10th final planting date. Over in North Carolina and parts of Virginia, we do see that June 30th is going to be the final planting. So you can see that there's vast differences in these final planting dates, even by crop. So what about cotton then? So we talked about corn and soybeans. What about cotton? Well, unsurprisingly, you see that the crop insurance offerings for cotton are going to be in what we would call the cotton belt, all across the southern part of the United States, not just in the southeast, but even all the way into Arizona and California and New Mexico. We see the sales closing dates are largely the same as corn and soybeans, but they differ by county. So you got January 31st, February 28th, and March 15th, just like in the corn and soybean case. The final planting dates for cotton, quite a bit of variation there. I mean, you can see in Texas, there's 8 different sales closing dates there in Texas. I mean, there's a lot of cotton that's grown there, and there's a lot of regional variation, I'm sure, in seasonal weather patterns. So there's probably some differences there. Looking over Alabama, there are 4 different sales closing dates. Georgia looks like it has 2 sales closing dates. Arkansas's got two different final planting dates. Final planting dates. Sorry. Rice. Okay, so rice, across the U.S., it seems like the plantings of rice and therefore the insurings of rice are located mostly in the Mississippi Delta region, parts of Texas, and then over in California. So in Arkansas, we produce over half of the nation's long grain rice. So unsurprisingly, most of Arkansas is going to be where the insured rice acreage is going to be. And there are a few counties there in Florida as well. But you can see that most of those are going to be February the 28th for sales closing. Final planting is going to be May the 25th. Okay, those are going to be the cash crops. What about fruits and vegetables? What about strawberries, watermelon, cantaloupe? What about apple trees, peach trees? All right, so whole farm revenue protection or WFRP is going to be the product that most of those crops will be insured under. There's also MF or the micro farm version of whole farm revenue protection. And those sales closing dates, this is for a calendar year filer because those sales closing dates vary by how you file your taxes as a business. But by and large, most folks are going to be filing by the calendar year. And if that is the case, we see that most counties will be in that March 15th sales closing date, but we'd still have others that are February the 28th and that southern part of Texas being January the 31st. And there's no final planting here because of the way that the whole farm program works, which there's a whole chapter on whole farm, chapter 10. We don't talk about it here in this presentation in great detail. There are a couple points that I make, but the final planting date is not considered in the whole farm case. Okay, let's get into the individual insurances, looking at yield protection and revenue protection. And what I mean by individual is farm level versus like a county level protection. So this is going to be insured at the farm level. There'll be a farm level history of yields that'll be used to determine guarantees versus a county history used to determine county guarantees. Excuse me. I cover a lot of ground here. There are 4 chapters, but don't think that I'm covering all 4 chapters to the fullest extent. I'm just pulling pieces from each of these chapters to talk about yield and revenue insurance. So the chapter on why does the federal government subsidize crop insurance, insurable unit structures in crop insurance, yield protection, revenue protection, and revenue protection with harvest price exclusion. So all these are going to be different parts of yield and revenue insurance and understanding yield and revenue insurance. So yield protection, let's start off with that. Most of the time people call it YP. The trigger for YP is going to be some farm yield. So the guarantee will be set on some APH or actual production history farm yield. So essentially, if the farm level yield is below the APH yield times the coverage level, you'll get a payment. And then there'll be a price election made to determine the dollar amount of indemnity. Whenever I give this presentation, I always ask people, why do you think that is? Why do you think there is a price election made to determine the dollar amount of indemnity for a yield product? Because it's a yield product, right? So in the yield case, we have production being insured. And so if you think about it, without the price election, RMA would then be legally obligated to like bring you soybeans to your farm that you would then market and then get cash for later. So to avoid that, because it just seems very inefficient, it is very inefficient. It's kind of similar there's a similar principle underlying that with futures markets and how those are based on delivery of grain. Well, in this case, we're not going to deliver RMA is not going to deliver the grain that you lost to your farm. They're just going to say, all right, let's just multiply it times a price, which will be a futures price. Let's multiply your loss times a price, and that's going to be the dollar amount of indemnity that we give you. So had you marketed those bushels at the RMA determined futures price, this is the amount of cash that you would have gotten. And that's the reason why there's a price election on a yield program. Okay, revenue program, RP, revenue protection, RP. And that trigger is going to be based on, again, that futures price and some APH farm yield. So now we're in the revenue space or the price times yield space. Under this protection, the producer gets to roll the dice on price twice. A lot of ices in there, right? So what I mean by that is that there is a spring price and there's also the fall price. There's going to be volatility around the spring price and there's going to be volatility around the fall price. So for revenue protection, the producer is going to get to choose the higher of those two prices. So you get to roll the dice once in the spring, roll the dice again in the fall, and the higher of those two prices is what your guarantee is based on. That's good, right? Because you want to get a higher guarantee. You want to guarantee more dollars. And so under RP, you get to guarantee more dollars by rolling the dice on price twice with the fall price and the spring price. However, it is more expensive because there is more risk protection than YP. Not only are you getting price protection, you're getting double the price protection with the fall price and the spring price. Then there's another RP called harvest price exclusion. This is HPE or RP HPE. Again, the trigger is going to be some futures price and some farm yield. However, the producer gets to roll the dice on price only one time, not twice. It's the harvest price exclusion. So the payment's going to be based on the guarantee that's set in the springtime price. So you don't get to choose between spring and fall. It's just the spring price. So really, if you anticipate prices falling and you believe that the price will remain high relative to the fall price, then this is going to be the way to go. I will say though, most folks put their acreage in revenue protection. By and large, most people put everything in revenue protection. Okay, so I will now give an example of how these products work using yields and prices at the farm level. I will be using Arkansas counties as examples, probably for obvious reasons. But here we're going to use Crittenden County, Arkansas for our soybean example, and we're going to choose the 80% coverage level. Our APH tells us that our expected bushels produced per acre will be 55 bushels per acre. So that gives us a yield guarantee of 44. So if you do the 0.8 times the 5.5, you should get 44 bushels. The projected price, I believe that was for this year, was $10.51. So $10.51 was what that futures price was projected to be at harvest time. The realized harvest yield was actually at 40 bushels per acre. So we will get an indemnity. Why? Because the 40 bushels is less than the 44 guarantee. So we had the 40 bushel realized yield. Our guarantee was 44. So the difference between those 4 bushels will be multiplied by the projected price of $10.51, and that gives us our indemnity, which is $42.04 per acre. So the indemnity is also the payment provided by an insurance company. The producer premium for this policy was $15 per acre. I went and looked that up from RMA, so this is an accurate pricing on that. So the net indemnity, or the indemnity net of the premium, so the cash in minus cash out, is equal to $27.04 per acre. So depending on how many acres you insured under this policy, the farmer would get paid $27 an acre and get a check for that straight in the mail. Or if they had an assignment of indemnity, they would get that check sent to their directly to their banker to pay off any loan obligations. Now we'll look at the revenue protection case. Again, in Crittenden County, we'll look at soybeans, 80% coverage level, 55 bushels, 1051. So all these things that are similar from the previous example. So now we have to look at a revenue guarantee. We're not looking at a yield guarantee, but a revenue guarantee because this is a revenue product. So we see the price times the yield, 55 times 1051 times 80% or times 0.8 gives us a revenue guarantee of $462 per acre. Okay, so let's say that again, we get a realized harvest yield as the farmer of 40 bushels per acre, and we get an RMA harvest price of 975. So we lost bushels and the price fell. Probably what a lot of folks realize this year, actually, a very realistic case. So they lost bushels and the price fell. So that means at harvest, our revenue was $390 per acre. So if you take 975 times 40, you should get $390 per acre. So if the harvest revenue is $390 per acre, and our revenue guarantee is $462 per acre, roughly, will there be a payment? Yes. If we do 462.44 and subtract off the 390, we get a payment of $72.44 per acre. Now, producer premium is $19 per acre. So the 72 minus the 19 tells us that we're going to be getting about $53 an acre, depending on how many acres. But per acre, we'll get that much in a check, mailbox money, direct deposit, or it could pay off loan obligations again if you have that assignment of indemnity. I think it's worth noting in this, not just for this case, but this thought just occurred to me. What if you don't have indemnity that's greater than your premium? So what if you're actually having to pay in premium? So yes, you will be asked to pay the premium, but if you have indemnity that's greater than the premium, you won't be asked to pay anything. It's just whatever's net. Whatever is net, that's what you get. So if you do have to pay, though, you will know it. So like if you're indemnity, so say you have an indemnity that's like $10 an acre, you still got to pay $9 an acre in premium, is how that would work. Okay, lastly, HPE. We've got soybeans again, all the same parameters, all the same numbers as before. The harvest price actually goes up on us. So this is instructive here. So we have HPE, the harvest price exclusion. Unfortunately, the price went up on us instead of it going down, but we're stuck with that 1051. We can't get the 1075. If we had the regular RP, we could have gotten the 1075. But because we have the HPE, we're still stuck with the 1051. So the harvest revenue is going to come in at $430 per acre. We're still going to get an indemnity, but it's going to be a smaller indemnity, a much smaller indemnity. Now it's $32.44. The producer premium of $15 per acre. So our net indemnity net of premium then is about $17.44 per acre. So still a net indemnity, just not as great as the one in the previous example. So you can probably see now why most folks are going to be enrolling in RP, because again, you get to roll the dice on price twice. Okay. I'll take a quick pause to take a drink. Any questions? Drop them in the chat. Unmute your mic, whatever you want to do.
I currently do not see anything in the chat. Is there any questions from the floor? I guess you can continue on.
Cool. Thanks, Tyrone. Okay, so now we're going to talk about unit structures. This is going to address the question of how do I insure my land? Some people, I think in the South, we use farm numbers, but in most other places, I do believe they use unit structures. And so now we're going to define what those unit structures are. How do we think about those? How do we group together our plots of land whenever we insure? And so there are three different ways to do that for these policies that I just described. Optional units, basic units, and enterprise units. So optional units provide risk protection at the lowest level of aggregation. What do I mean by that? That's a pretty big A word there, right? What I mean is you can get pretty specific, and we're going to see a visual example of this in a minute because I'm a visual learner. But if it's the lowest level of aggregation, if you're thinking about maybe like a Russian nesting doll, that's going to be the smallest doll that we're going to have in that pack. So get down to pretty much to a field level, okay? That can get pretty specific. So you can insure at the field level and by lease agreement and by section. However, the lease agreements are separated by own cash rent versus crop share rent. Again, we're going to look at some of the differences here in just a moment. Basic units, they are one level higher of aggregation than optional units. So basic units make up optional units. So if we're, again, moving in our Russian nesting doll, we're going to go from the smallest and then we're going to put that one into another doll, okay? This allows a producer to insure at the field level by lease agreement, but you group together the sections that the land is in. Enterprise units have the highest level of aggregation. So if you're going to have three nesting dolls, we're going to have all of those into one Russian nesting doll. It allows a producer to insure all fields in a county under one unit and by crop. but you must have at least two separate insurable fields in a given county. So you can't just have one field in a county and call it an enterprise unit. Really, that would need to go at least under a basic unit. So it's to prevent folks to just have one field from calling it enterprise unit when it's like, yeah, technically it is, but I do think it's a way to keep folks from, I guess, double counting in some ways. Okay, so insurable units with optional units. Well, let's take a look at optional units. So we have different farms here, farms A, B, C, D, E, F, and G. They're going to be in the same township, but four different sections. So we have sections 1, 2, 12, and 11. So the question that I have is, how many optional units are there? So I'll give you a moment to look. You don't have to verbally answer if you don't want to, but just take a look at this plat map. This pretty much is what this is a sample plat map. Just take a look at that. We have 1, 2, 3, 4, 5, 6, 7 different farms, different ownership structures, different even crop share. Amongst the crop shares is a 50-50, a 60-40. We got 7 altogether. So more or less than 7, it's actually 6. So how are they going to be grouped? Farms A and C. So again, with the renting, the owned and cash rented land will be grouped together within a section and by crop. So here's one optional unit, farms A and C grouped together into one. Farm B, it's in a crop share. And so with this crop share, we see that there are 2 optional units in this one section. So section 1 has 2 of those optional units. Farm D is a cash rent lease from Jones. So again, the cash rent is going to be separate from a crop share. And so then we have Farm E is a 50-50 crop share. So there's also 2 optional units in section 2. Farm F, all the land in that section is owned. So it's going to go under its own unit. And then we have the 60-40 crop share under Farm G in section 11. And that's all the land that we're farming in that section, so it gets its own optional unit. So these are the 6 optional units. So you can see how disaggregated, it's the least level of aggregation, right? So how disaggregated the land is when we go to insure it. So this is really important when maybe in section 11, that's a floodplain. Maybe that Farm G is in a floodplain and it's prone to flooding a lot. Maybe you want to put it in its own unit. Or in a case that we're going to talk about in a moment, what if all this ground is actually very similar? What if it's all similar and we can get a cheaper premium because we get enterprise units? That's something to kind of start priming your brain about. But in this case, if you've got like a problem field, which I know that farmers are talking about having that one field that really creates problems for various reasons, consider putting that into an optional unit. Now, basic units. So we're going to go up one level in aggregation. How many do you think that there are? So if we're going up a level in aggregation, there are 6 optional units. That means that there are less basic units. Indeed, there are 3 in this case. So farms A, C, D, and F are all owned or cash rented, but we're going to combine across the section. So you see we're in section 1, section 2, and section 12. We're going to combine all that land to one basic unit. So you can see that this one basic unit contains 3 optional units from before. Farms B and E, we see that it's a 50-50 crop share from Smith, and we're going to go across sections. So under that agreement, we're going to combine that ground. So that's going to be combining 2 optional units as to get to one basic unit. And then Farm G, it's still its own basic unit, sitting over there in section 11 because it's a different crop share agreement. So how many enterprise units do you think that there are? If there are 6 optional units, and it's the least aggregated, and there are 3 basic units, and it's a little bit more aggregated, and we know enterprise units are the most aggregated, how many do we think that there are? More or less than 3? It should be less than 3. In fact, it's only 1. So with an enterprise unit, think about it by enterprise. I want to insure all of my production by enterprise. So we want to insure it by corn, by soybeans, by cotton, by rice. And so we're going to insure all the ground that we're producing rice in into one enterprise unit. So this is a good case if all the yields, all the production is very closely related. If they're all very similar or highly correlated, you want to put all your ground into enterprise unit. You get cheaper premiums, you get more subsidy on that. But again, if all your ground that you're farming, if there's a lot of differences in that, in all the pieces of ground that you're farming, then the basic and optional units are going to be a better choice. All right, so speaking of subsidies, let's talk about those for a minute. So what I've got here is different coverage levels and different ways to insure. So the basic and optional units you see is the second column, and then there's enterprise units. We just talked about those. That's going to be under the yield protection, and revenue protection harvest price exclusion. Then we have SCO, ECO, stacks, margin protection, margin coverage option. All those are going to be area insurance or county level insurances. So just to focus on what we just covered with basic and optional units, these percentages are going to give you the portion of the premium paid for by the government. So RMA is going to determine an actuarially fair premium, which means it's a break-even business type of premium where the amount of premium paid to the insurance company should be same as the indemnity received by the farmer. It's a break-even business. No one's making money. Risk is purely being managed. And so that's in the actuarially fair case. This is saying part of that actuarially fair premium will be paid for by the government as well as by the farmer. So at 50%, we see 67% is what's paid for by the government. That means that the farmer is responsible for 33% or for 1/3 of that. All the way up to 85%. And these percentages are reflective for the 26 crop year. This is a change that was in the One Big Beautiful Bill was the coverage levels from 55% to 85% all got increases. So these are current. So the 85% coverage level gets a 41% portion paid for by the federal government. So that means the farmer will pay for 59% of that premium. Under enterprise units, there were no changes to enterprise unit subsidies that I'm aware of, but all the way up to 70%, 80% of that premium is going to be paid for. So 4/5 of that will be paid for by the federal government, and then it changes at 75%. But regardless of the coverage level, from 50 to 85%, over half of that actually for a premium will be covered under enterprise units. SCO across the board, 80%. That's an increase from 65%. ECO increased to 80%. That was an increase, I think, from like 55% and 45%. So big increases there. Stacks did not change. That's only for cotton. We're going to talk about that briefly in just a moment. Margin protection, that's going to be for corn, soybeans, rice, wheat, and that's for certain counties across the country. Those are its subsidy percentages, and then there's a margin coverage option those are its percentages. The point's not to go into great detail on those programs as much as it is just to show that there are differences in subsidies across coverage levels and across programs. But to dial it back to what we just talked about, this is going to be the batch, I guess, or the schedule of subsidies attached to each of the coverage levels for the products that we just talked about. Enterprise as well. Okay. I do want to talk about whole farm revenue protection real briefly because it got some changes in the One Big Beautiful Bill Act. With whole farm, there now is a 90% coverage level. I'm showing you here the table 2 that actually needs to be updated now that I'm looking at it. It goes to 85%. Well, there's actually a 90% coverage level now. So the coverage level goes from 50 to 55 all the way up to 90% now under the update in the One Big Beautiful Bill. And it faces the subsidy percentage, the same one as 85%. So the 90% will also face the 53% subsidy rate. And that'll be the same for the whole farm case. So there's an enterprise unit, and then there's a whole farm unit. So the enterprise unit, you see the 80s going all the way from 77 to 68 to 53. That's the exact same in the whole farm case under the enterprise unit. So if you have a whole farm policy and all you're insuring is tomatoes, or all you're insuring is peaches, or all you're insuring is apples, all you're insuring is watermelon, you get the enterprise unit subsidy for one crop. But if you're insuring peaches and watermelons and tomatoes and cantaloupe, then you're going to get into the whole farm subsidy, and all the way up to 75%, you can get 80% of your premium paid for. So the ideas here really are the more crops you insure, the more premium that you'll get paid for by the federal government. So less premium expense. More crops insured, less premium expense. But regardless of the coverage level, over half of the actuarially fair premium will be covered by the federal government in the whole farm revenue protection program. So that's all the individual coverages, individual farm level coverages. What's next? Area insurance or county level insurance. So here I do pull from chapter 4 specifically. Here's a QR code again, if you weren't able to catch that QR code from before. What is area insurance? Area crop insurance guarantees are based on a trigger that covers area beyond your farm. So we're talking about county level most of the time, but it could be a grid cell as well under the pasture rangeland forage insurance. Um, ARC-CO, agricultural risk coverage at the county level, is an example of an area risk management product. You're just not paying a premium for it. That's that FSA program that you're not paying a premium for, but it's still an area risk management tool because it's a county level risk management tool. Some other examples in the crop insurance case specifically include the supplemental coverage option or SCO. There's the enhanced coverage option or ECO. And then there's the stacked income protection or stacks, which is only for cotton. And then there's the margin protection program, which I mentioned before. We're not going to go into great detail on all these. These are just examples of what that area insurance is. SCO is an area product that must be purchased along with the underlying policy. So YP and RP, you cannot buy SCO on its own. You also have to purchase YP and RP. It is meant to supplement the underlying multi-peril crop insurance or MPCI coverage. So it's meant to supplement your YP, meant to supplement your RP. It has one coverage level of 86%, but it supplements all the way down to whatever your individual YP policy is. We'll look at a picture of that in just a moment. So if you have 75% YP, it goes from 86% covers down to 75%. So it provides that coverage down to the underlying individual coverage level. So again, if you have 75% RP or YP, you can purchase SCO RP and receive up to 11% of your expected revenue in the form of an indemnity payment if it's triggered. Now, under the One Big Beautiful Bill Act, or the OBBA, or OB3 is what I tend to call it to save some time and some breath. Under OB3, you can purchase this product if you have the same acres in ARC-CO, or the agricultural risk coverage at the county. Before the OBBA, you couldn't do that. So before OB3, you couldn't do that. You couldn't enroll in SCO and ARC, but now you can enroll SCO and ARC in the same acres. Also, some other changes in the One Big Beautiful Bill. SCO coverage will be at 90% for 2027. I know we're going into 26, but it will increase from 86 to 90% in 2027. And it will remain at 90% until Congress changes it. But for 2026, the SCO coverage level will still be at 86%. As I mentioned earlier, whole farm revenue protection, the maximum coverage level is increased from 85% to 90%. And it will face the same subsidy rate as the 85% coverage level, which was 41% in the enterprise unit case. Okay, this is a picture of enrolling those same acres. So this is to show how it would look if you're trying to guarantee yields or revenue using crop insurance and ARC-CO. So the green's going to be your, let's just call it RP, revenue protection, and we're going to purchase 80% coverage. With SCO at 86%, that butts down to 80%. So there's a 6% band that SCO covers. And then let's say that we get the ECO, or the enhanced coverage option, at 95%. It goes down to the 86% coverage level for SCO. So you can see in the insurance case how these stack up. And then you see ARC has a coverage level that's increased to 90% at a 12% max payment rate. So all the way down from 90% essentially to 78%. So you can see how it actually goes into that 80% coverage for RP. You can package all this into one. So I encourage you to talk with your farmers about that. If you farm yourself, I encourage you to talk with your agent about this. And I think this is a great change in the One Big Beautiful Bill. I do think it's a great change to be able to put these policies together, put it and package it all into one. It's not an either or, it's a both and now. It used to be either or up until the passage of One Big Beautiful Bill. However, you still cannot enroll stacks with seed cotton base that's in agricultural risk coverage or PLC. So you still got to make a choice of either going with ARC or PLC or stacks for cotton. That's for cotton only. All the other crops, you can do this pairing with ARC and SCO, ECO, and RP. There are some changes to the beginning farmer and rancher subsidy rules. That's also great news. Your eligibility as a beginning farmer is increased from 5 years to 10 years. BFRs can maintain status twice as long now. So instead of 5, you go to 10. In addition, there's an extra, in addition to the extra 10 percentage point reduction that came already. So there was already a 10 percentage point reduction in that premium for a beginning farmer. In your first 2 years of eligibility, you get another 5 percentage point reduction. So that's a 15 percentage point reduction just for being a beginning farmer and rancher. So if you have enterprise units, that means up to 95% of your total premiums paid for. You're only on the hook for 5% of that premium if you're a beginning farmer and it's your first 2 years of eligibility. That's huge. Beginning farmers have a 3 percentage point reduction for the third year, so up to 93% of that premium is paid for. And then in the fourth year, beginning farmers have a 1 percentage point reduction for the fourth year. So up to 91% of that total premium can be paid for. It reverts to only the 10% percentage point reduction in years 5 through 10. Visually, what does this look like? So we see our eligibility year on the x-axis on the bottom in years 1, 2, 3, 4, 5, 6, 7, 8, all the way through 10. We see that in year 1, in the original case, only 10 percentage points were covered. Under the One Big Beautiful Bill, it goes up to 15 percentage points are covered. Looking at year 2, 10 to 15, year 3, 10 to 13, year 4, 10 to 11, and then in year 5, it just goes to 10. But you'll look and see in year 6 through 10, there was nothing for a beginning farmer in terms of premium subsidy assistance. Under the One Big Beautiful Bill, there now is. So if you're looking at year 6 through 10, now you get those 10 percentage points there, whereas before you couldn't. So you see the 0 going all the way up to 10, that goes up into year 6 through 10. Now we'll talk briefly about ECO. ECO is an area product that must be purchased along with YP or RP. You do not have to purchase SCO to get ECO. You can get ECO on its own. It has coverage levels of 90, 95% and provides coverage down to 86% of expected revenue. The intention is to enhance the supplemental coverage option, but you don't have to buy SCO and ECO. You do have to buy SCO with your RP, but you also have to buy your ECO with your RP as well. So what does this look like? I already showed you this in a different figure, but just isolating the crop insurance aspects of it, this is how these stack up. So we have our 75% policy here, SCO stacked on top of that, ECO stacked on top of that, and there's still a 5% deductible on top. So you're covering 95% of expected revenue if you pair together all three of these. For stacks, it is an area revenue product that is intended specifically for cotton and has coverage levels of 75 to 90%. It provides coverage level down to some underlying individual level, just like the others. But it can also be purchased as a standalone product. Stacks came to be because of the 2014 Farm Bill. What happened with that is the seed cotton program was deemed red box in terms of World Trade Organization policy. So the World Trade Organization said that providing assistance for cotton violates trade rules. And so seed cotton became ineligible for your FSA programs. So the response was to create this RMA crop insurance program, and that's how Stacks came to be. Although I'm not sure how long Stacks is going to be around now that we have these new rules for ECO and SCO, some new rules and new products, but still available. And if you have questions, happy to take those as well. But you can purchase 75% revenue protection, the farm level protection, and a 90% stacks policy, and still receive up to 15% of your expected cotton revenue just on stacks alone. Now, you cannot stack this with SCO, ECO, or with ARC or PLC. Like I said, it's got to be a stacks or ARC or PLC for cotton, or you can put your cotton in SCO, ECO, and YP or RP. So you can see already why I think that stacks probably won't be hanging around too much longer. You don't really need it. I mean, you have your enhancements with SCO and ECO now. But nonetheless, we'll show how this works. So if you were to pair your RP with stacks, the graph on the left would show you that you can get up to 90% of expected revenue covered for cotton with a 10% deductible. But also on the right, you can see the motivation, I guess, for why you cannot pair your stacks with ECO and SCO, because they effectively provide the same amount of protection, the same measures of protection. And so that's what the hash marks indicate, is that overlap in that protection. Now, if you do just get stacks as a standalone product, you see there's a brown or a black looking downside loss exposure. That's because you didn't get the RP. So if you didn't get the RP, you have this downside loss exposure from only buying the standalone stack. So I guess that's an upside of stacks. You can buy it by itself. You don't have to buy RP and SCO and ECO. You can buy just the stacks. Whereas with SCO and ECO, you got to buy some level of underlying RP or YP. Okay, this will be the last part of the presentation. As we wrap up, we're going to talk about the jointness of federal crop insurance and farm bill programs like the FSA programs. So there's the PLC or the price loss coverage, right? And then you can do that and not do anything else. There is the ARC or agricultural risk coverage. You can do that and not do anything else if you wanted to. You can do revenue protection and price loss coverage. You can do that as a combination. You can do that jointly. And really, the point of this is just to show that really you can't just think about FSA only anymore. I mean, consider crop insurance too. It's all going to go together ultimately. Strategy 4, you can do RP and you can do ARC. You can do RP, SCO, and PLC. You can do RP, SCO, ECO, and PLC. You can do RP, ECO, and ARC. And then you can do all of these, RP, SCO, ECO, and ARC. So 8 different strategies here. I'm sure it begs the question, which one is the best? It depends. You gotta love economists, man. You gotta love us. It depends. And it really does depend. It really does depend on a few factors. There will be differences in premium expense depending on how much or how many products that you buy. So you buy more products, more premium. You buy a higher coverage level for one product, more premium. So that's going to factor into this. So think about this. RP plus SCO plus ECO, that's going to be a few more bucks, a few more dollars in premium than just RP and ECO because you're not paying the premium on the SCO anymore. PLC payment rates vary greatly by crop, with some crops much higher than others. I'm not sure if you saw there was a Farm Doc Daily article that came out showing those anticipated average PLC payment rates, and there are definitely some vast differences. On my end, I've actually calculated those differences at the county level, and I mean it's not lost on anybody. Rice, cotton, and peanuts shown to have very significant PLC payments. And so that's going to play into this versus if you go PLC versus ARC. Corn, soybeans, wheat, I anticipate to be mostly ARC, although in some cases, PLC for corn could be a better way to go, or PLC for wheat. So in 2026, I would say corn and soybeans is likely to go in ARC, while rice, cotton, peanuts are likely to go in PLC. But it depends on which county that you're in too. The reduced restrictions on going ARC plus SCO will be a game changer this year. Like I mentioned earlier, before you couldn't put acreage in both of those products. Now you can do that. But you still cannot enroll the same cotton acres in stacks as ARC and PLC. So here's an example of using ECO without buying SCO. So what I had before, I've got this table up here where I show, okay, what if we do strategy 7 here and we say, okay, RP, ECO, and ARC, because you don't, as I was saying earlier, you don't have to go with SCO and ECO. You can just do one or the other. Okay. But one issue that arises that you see, and this is the example for soybeans. So like say we have a expected revenue of $578 per acre for our soybeans. ECO is going to cover us from 549 down to 479 per acre in terms of revenue, but from 479 to 462, there's still $15 of lost protection before the 80% coverage for revenue protection starts to trigger. So you can see there's price downside all the way from 100% to 95% for ECO, but there's also that missing band between RP and ECO. But, SCO can fill that gap. You can buy SCO and fill the gap. Maybe the gap doesn't matter. Maybe on your farm, you're really not worried about deep losses all the way down to 80%. Maybe most of the time for you, it's going to be that 5 or 6% loss in yield. Do you really need anything beyond ECO? That's totally up to you and having that discussion with your crop insurance agent, but I'm saying maybe it doesn't matter if you only have shallow losses at the farm level. And it depends on your risk tolerance. So if you're willing to take on more risk and pay less in premium, then by all means, please do that. So again, same example, except here we're going to add on the ARC coverage band. And so we see how this band overlaps with ECO and with our expected revenue. But the FSA revenue guarantees in this example are higher than the USDA RMA revenue guarantees. There are differences that arise. That's the point of this slide, is to show there are differences between the RMA programs and the FSA programs. The ARC co revenue guarantees at 584. RMA's expected revenue before coverage levels is 578. 80% of RMA expected revenue is 462. 86% of that's 479. 95% of that is 549. So think about this. You got 85% of RMA expected revenue, which is the 462. The total premium for this policy would be $31. And you got a difference. If you have a complete and total loss, would pay you $431 per acre. The ARC guarantee is 584, and it only covers about, I think it's now 12% band of coverage. So 12% of that is what you would get on top of the 431. So differences between FSA and RMA guarantees do matter. I'm not saying one is particularly better than the other. Better, we got to define that, right? But I will say that they manage different sources of risk. We got farm level yields versus county level yields. We've got cash prices, season average cash prices versus futures prices, which are going to be global prices. So they just manage different sources of risk. And with that, I know that's a lot of information. Happy to provide these slides to Scott or Tyrone or to whoever. Here's a QR code for our newsletter that we provide education in this area weekly, and in many other areas, not just in insurance. And then we also have a podcast that provides some verbal commentary on what the newsletter is covering. There's my email, my phone number. With that, thank you so much for your time. Really appreciate it. Are there any questions? I'm happy to entertain those as long as y'all would like.
Are there any questions from the floor? I see no questions in the chat. We can all give a Zoom reaction. Thank you. As a livestock person background, I thought this presentation was very, it kept my attention. I did learn some things on this about crop insurance. That's why I'm a livestock person, I see. But definitely, thank you for your presentation. I'm looking now still, any questions from the floor? Okay.
Hey, Hunter, this is Will
This will be
Strader.
shared on YouTube.
I think somebody's chimed in.
Somebody chimed in. Go ahead.
Yeah, hey, Hunter, this is Will Strader, North Carolina Extension. Just curious if you know the premium versus payout for prevent planning nationwide.
Mm-mm. Nationwide, as in like total indemnities on PP paid out versus the total premiums collected on those policies?
Yeah, is it costing money for them to offer that, or?
Overall, I think it's a pretty fair loss ratio, actually. Overall, I think it's close to one. But it does depend on the region. Like some regions, it's not covering the premium. Some regions, it's covering more than the premium. I would definitely say in areas where there's more rainfall, we do see more PP indemnities being paid out than the premiums collected on it necessarily. And drier regions, not so much the case. But I do think it really depends on the region, is what I would say to that.
Yeah, thank you.
Thank you for that question. Are there any more questions on the floor? Again, this seminar will be shared on YouTube. Please share it to your pages. It's very informational in today's times and needs. So again, Dr. Hunter, thank you very much for your presentation, and look forward to communicating with you in the future as well.
Absolutely. A big thank you to NACAA, and I appreciate you guys and gals having me on and y'all support, and look forward to future partnerships.
Home run. This will conclude our first NACAA 365 seminar. I hope everyone have a blessed day.